The market is completely, and I mean completely confused about United Natural Foods. You look at the stock, it's up, but you read the latest report, well, it's a bizarre mix of solid steel and some very visible cracks. We're here at Iron Financial to run a full structural inspection because our mission is to help you forge a stronger portfolio and cut right through this kind of market weakness.
All right, here's our inspection plan. We're going to break this company down layer by layer. First, we'll look at their conflicting blueprint. Then, we're going to get our hands dirty looking for cracks in the revenue foundation. After that, we'll test the strength of its profits, put that heavy debt load through a stress test, and we'll finish up with our final verdict on the whole structure. Let's get to work.
So, the very first thing that jumps out on the blueprint is this huge contradiction. Honestly, it's the kind of thing that makes you wonder if the architects were even talking to each other. Let's just get right into it, because this is the real core of why the market just can't figure this company out right now.
This slide right here says it all. It perfectly illustrates the conflict we're talking about. On the one hand, you have a solid, undeniable beat on earnings per share. Management absolutely delivered where it counts, on the bottom line. But on the other hand, they missed their revenue targets. Sales, the actual lifeblood of any company, came in light. So how in the world can a company make more money while selling less stuff? That is the multi-billion-dollar question we have to answer today.
Every strong portfolio we build is made of companies with a rock-solid foundation. You can have the most beautiful, impressive-looking skyscraper in the world, but if the concrete underneath it is crumbling, if it's built on sand, the whole thing is worthless. For any business, that foundation is revenue. So let's put on our hard hats and test this one for weaknesses.
First, let's just get one thing straight. This company is an absolute behemoth. We're talking nearly $32 billion in sales over the last year alone. This isn't some small-time player we're dissecting. UNFI is a critical, absolutely essential part of the North American food supply chain. The scale we're dealing with here is just immense.
Immense? Okay, I'll give you that. But it's an immense company that's not meeting expectations, and that, right there, is the first major crack in the foundation. Wall Street was looking for over $8 billion in sales for the quarter, and they came up short at $7.95 billion. That's a shortfall of about $160 million. In a business like food distribution, where the margins are razor thin, every single dollar of sales counts. Missing by that much gets noticed. It's a bright, flashing signal that top-line demand is softer than all the experts predicted.
And this isn't just a one-off issue, not some random bad quarter. Just look at this chart. They've lowered their forecast for the entire year. You can see how that new bar on the right is visibly shorter than the previous one. They've chopped the midpoint of their revenue guidance from $31.8 billion all the way down to $31.2 billion. That's a $600 million haircut. The company itself is signaling to the entire market that its revenue foundation is weaker than even they thought it was. And for any investor, that is a clear, unambiguous warning sign.
Okay, so the foundation is shaky. It's got cracks. That's a huge red flag, I get it. But why is the stock up? Is this a controlled demolition, or is there something else going on here? Are the walls of this place strong enough to actually hold the roof up? I want to see the good news in this report. Show me the numbers that are actually driving the stock price higher. Where is the steel in this structure?
This right here. This is where management is doing the really heavy lifting. This is the counter-argument to all that revenue weakness, and believe me, it's a powerful one. They blew past earnings expectations. The street was looking for an adjusted earnings per share of 51 cents. UNFI came back and delivered 62 cents. That's an 11-cent beat. That is a significant outperformance on the bottom line, proving they can forge profits even when sales are under intense pressure. And just like they signaled weakness on revenue, they're signaling incredible strength here. This isn't a fluke. They are so confident in their profitability machine that they've actually raised their forecast for adjusted EBITDA for the entire year. They've lifted the midpoint from $665 million up to $695 million. Now let that sink in for a second. Their sales forecast is going down, but their profit forecast is going up. They are making more money on less sales. That, my friends, is a management team executing with absolute surgical precision.
All right, so how are they pulling this off? This isn't magic. It's got to be coming from somewhere. And this slide, this looks like the playbook. They're getting lean, they're cutting costs, and they're getting brutally more efficient. A 6% drop in operating expenses? That's huge. Better on-time deliveries means happier customers and a lot less waste. And that free cash flow number? $243 million in a single quarter? That's real cash they can use to strengthen the business. They even had enough left over to buy back $25 million of their own stock. So is this all just hype, or is this real sustainable operational improvement?
Oh, it's real and it's 100% deliberate. This is no happy accident. This quote from the Guru Focus Analysis confirms it perfectly. They are executing a very clear strategy to reinforce the business by focusing intensely on the things they can actually control: their network, their processes, their technology. They're making every single dollar, every truck route, and every employee hour work harder for them. This is a company that is fundamentally transforming itself from the inside out.
Okay, let's just quickly recap our inspection so far. We have a weak foundation in revenue, but it's being supported by these incredibly strong, reinforced walls of profitability and operational efficiency. So now we move to what could be the biggest potential point of failure for any company, especially in a tough economy like this one: the debt. We're about to put this balance sheet under a full stress test.
And whoa, that is a heavy number. A debt-to-equity ratio over 2, sitting at 2.24, that suggests a really high level of leverage. What it means is for every dollar of equity the shareholders actually have in this company, there's $2.24 of debt sitting on top of it. Now, in good times, that leverage can amplify your returns. But in bad times, it can be an anchor that drags a company straight to the bottom. This is a significant risk factor we absolutely cannot ignore. It's a heavy weight on the entire structure.
That's exactly right. And to really understand how they're managing this weight, we need to look at something called the net leverage ratio. This is the metric that matters most to lenders and to smart investors. See, it's not just about how much debt you have. It's about how much debt you have relative to your ability to generate cash to pay it back. Think of it this way. This is the crucial number that shows if the debt is becoming more of a burden or less of one.
And this, right here, is where the story gets really interesting. Look at the clear and aggressive downward trend. They are not just managing the debt, they are actively attacking it. Their net leverage ratio fell sequentially to its lowest point since fiscal 2023. But here's the real kicker. They just pulled their long-term target forward and made it more aggressive. They're no longer aiming for below 2.5 times in the future. They now expect to hit around 2.3 times by the end of this fiscal year. That is a massive signal of confidence in their cash-generating ability.
And here's the proof. They've got the cash flow to back it all up. That $243 million in free cash flow, that's the ammunition. And you can see, they used it to slash their net debt by $219 million in just 3 months. They're not just talking about paying down debt, they are actually doing it, and they're doing it aggressively. And on top of that, they have $1.34 billion in total liquidity. This is a major reinforcement. It tells me they have a significant financial cushion to withstand shocks and keep executing their plan.
Okay, our inspection is complete. We've examined the blueprint. We've pressure tested that revenue foundation and found some serious cracks. We've checked the load-bearing walls of profitability and found them to be solid steel. And we've stress tested the debt load and seen a clear, aggressive plan for reinforcement. It's time to lay it all out and make the call with our final verdict.
And here it is, our official structural integrity report. On the left, in the strengths column, you see the solid steel beams, powerful profitability growth, incredible gains in efficiency, and a balance sheet that is getting stronger and more resilient every single quarter. But on the right, you see the potential fault lines. We've got that declining revenue, of course. We also have a negative net margin, which means after all expenses, they're technically losing a tiny bit of money on paper right now. The debt to equity is still high, and we have a low Piotroski F-Score. That's a 9-point financial health checklist, and a low score like 3 suggests some underlying weakness. Finally, you have the constant, brutal competitive pressure of the grocery industry. It's a classic battle between a company mastering its internal operations while fighting powerful external headwinds.
So it's really no surprise that Wall Street is split right down the middle on this one. The consensus rating is a hold. They see the exact same conflict we've just laid out. They see the incredible potential in the operational turnaround and the rapid debt reduction, but they also see the very real risk in that crumbling revenue foundation. They're basically telling investors to wait and see. Interestingly, though, that average price target of over $40 a share, well, that suggests that if UNFI can just fix that top-line leak, there could be significant upside from here.
So the crucial point, the bottom line, is this. United Natural Foods is a company conducting a major renovation while the store is still open for business. They are tearing out old plumbing and reinforcing the walls, all while trying to keep customers coming through the front door. The question for your portfolio, the question you have to answer to forge a stronger financial future, is whether you invest now. Do you bet on the proven strength of their operational walls and the skill of their construction crew? Or do you wait on the sidelines until that revenue foundation is fully repaired and certified solid? That's the decision on the table today.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.